After they hit the July 4th deadline, we have a bill. We have a, I don't know if it's big, I don't know if it's beautiful, but it's big. What did this bill change as far as tax brackets for individuals? So hello friends. Thanks a lot for joining us. This is Steve Taylor again, the founding advisor over here at Merited Wealth. And we have a follow-up podcast with my very good friend, Brett Landsman. A few weeks ago, almost maybe a couple months ago, we recorded a podcast when the one big, beautiful bill was announced and all the possibilities out there. And we kind of guessed what might be in there. We talked about some of those major topics. But now, lo and behold, after they hit the July 4th deadline, we have a bill. We have a, I don't know if it's big, I don't know if it's beautiful, but it's big.
It's
It's
big, and
it's really
you
big.
and I both have something in common with the big beautiful bill. We're both big and beautiful.
There we go. Two big and beautiful guys talking about the big beautiful bill.
Yeah,
So we're going to try to like break it down to some of the easy stuff and go through. I think a lot of what we were thinking about, not a lot, but most of the big stuff really didn't pass. And not, I don't want to say that didn't pass. It's not much of a change from what we had in his first, Trump's first administration in this bill. So let's go through, first of all, Brett, the most practical, talk a little bit about tax brackets. What have we seen? What did this bill change as far as tax brackets for individuals?
I mean, the tax brackets are now permanent from the original 2017 Tax Act, so those are going to be the same pretty much with an inflation adjusted, amount, going up every year. So those were made permanent. So we won't see a change as far as those brackets are concerned. It will be, very similar to what, we've seen in the past.
Yeah, I saw that also. There was not much change there. So when we're doing our planning and we're looking, to try to get someone reduce their taxes by doing contributions or whatever it might be, it's going to look a lot the same as it has in the past, almost exactly the same as far as those tax brackets. But deductions, right? The deductions, I think there was a lot of big change there. So I know there's this new standard deduction, there's this new deduction for seniors, and the standard deduction, kind of changed a little bit. What happened there? What became permanent in the act there?
The amounts are still going to be inflation adjusted, but if you're a senior over age 65, there's going to be an additional standard deduction of $6,000 for seniors that are filing as a single taxpayer, and 12,000 if you're filing as a married filing, joint couple where you're both over the age of 65. The original, intent was, no tax on Social Security. That did not make it into the one big beautiful bill. So this is a deduction that kind of offsets some of the tax, treatment of the Social Security benefits that are still in play, that never do that. That remains the same, the taxability of Social Security.
Yeah, it's really interesting. That's something brand new. This additional deduction for people over age 65, and it's meaningful, right? It's 60, like you say, it's 6,000, and if you're married, 12,000. And I think that's really going to help out maybe people at the more modest income levels that they're getting that additional deduction to lower their income. Because as you said, we'll talk about it briefly. Social Security didn't really change. So we have this additional standard deduction. How about the standard deduction itself in general? We didn't see much change there. It pretty much just kept as is with inflation adjustments.
Yep, stay the same. 30,000 or 31,500 for a married couple, 15,750 will be the standard deduction. You still, we'll talk about it in a few moments, but you also, you compare that to what your itemized deductions are going to be. You're able to take the greater of the two. A lot of people, fall into the standard deduction. You'll see a similar amount, compared to previous years, but and there are some wrinkles in this itemized deduction, some new things in there that can help as well.
Yeah, we'll go through that here in one second, but like you did say, there was a lot of talk about exempting Social Security from being taxed. That didn't pass. That didn't change. So we're not going to go through it here, but for those of you on Social Security, how Social Security gets taxed, That's kind of, it's interesting, depends on your other income and what level it puts you into. So just know as you're thinking and you're planning Social Security, that hasn't changed.
That
Now,
and yeah,
yeah,
and making sure that when you do your 2025 tax return, that those deductions, those extra standard deductions, if you are filing and getting the standard deduction, apply because you do qualify for that.
yeah. And Brett, as two big, beautiful guys, right? We like our salt.
Yeah,
And
yes.
salt has come back, right? That's
Salt's
the
back.
state and local income tax. And that was a really big talking point. The politics was all over the place on that. So what did the big beautiful bill give us finally as our salt deduction?
So the salt shaker's a little fuller now. We were able to deduct $10,000 was the cap between property taxes as well as state and local taxes if you live in a state where you're subject to personal income tax. We're in Florida, so we just get a cap on our property taxes with some sales tax estimations. Now they've brought up that $10,000 number to $40,000. And so now that threshold is 40,000. If you are in a certain income earning bracket, that number will start to decrease. That 40,000 could work its way down to 10,000 again if you make, over a certain amount of money. However, most people will fall into that $40,000 increase now.
Yeah, yeah. So again, that big additional, deduction in there to help lower your taxes, right? But if your income is really, is too high, is much higher, you're still going to, not really fully feel the full benefit of all the taxes that you're paying on your home, right? So that's changed. Now, in regards to itemized deductions as well. Something changed on the charitable deduction side, which I found was really interesting. Rather than talking about caps, they imposed this new floor. You see that, Brett? So what's that about? What's this new charitable deduction floor that you have to meet?
Yeah, if you have a certain income that you earn, they start to compare a phase out of how much charitable deductions you're actually able to deduct. And it's actually a pretty, complex formula, and it's something to be mindful for, especially if we have, if you're a taxpayer who donates, securities to, stocks to charities or making large contributions every year and is in a higher income bracket, those benefits of giving money actually start to decline in some way. So it's something that needs to be a part now of your planning on an annual basis as far as giving to a charity.
Yeah, that's really interesting, right? There's never been kind of a threshold you need to get over to get that deduction, but that's interesting. I
Very
learned
similar to the medical. It reminded me of the medical deduction where they have the 7.5% of your AGI floor, so you would have to have significant, medical in order to achieve to even get a dollar of that deduction. A similar situation now with the charity.
Yeah, yeah, really, really interesting. Some different changes. There's something interesting there. I don't know if you saw the one about wagering losses, right? That you can only deduct your wagering, your betting losses versus, the wins to offset your wins. Now there's an additional a provision that says you can only deduct 90% of your losses against your wins. So like at a certain level, you're going to have to pay taxes on your gambling winnings. And I guess this is an acknowledgement to what a big part of our society now this gambling is, right? And they're going to say, they really, okay, right. It feels to me they're kind of accepting and saying, okay, we're going to make sure you pay some tax. I mean, what are your thoughts?
Yeah, I think with like you're saying, with DraftKings and sports betting and just online betting, it's I think, the casino usually wins, fortunately, but you have some times where you play the slots and you get lucky or lotto winnings. If you have a big lotto winning, um, looking into annuitizing those payments or, not taking the lump sum, those come into play, those type of discussions. I mean, I bet on the Dolphins every year, so I'm lucky. I
That's a
am lucky to be
loser.
fine. I'm gonna, yeah, you can't deduct losses if you don't have any winnings, but yeah,
Yeah, I told all my my friends this year the Dolphins have entered the NHL. That's the no hope league.
yeah, pretty
Yeah.
much.
So, in addition to that, we have, our itemized deductions change, right? Miscellaneous itemized deductions are gone, right? That was those are subject to a 2% floor as well. But now they're going to add some new like educator expenses and stuff that they're going to say it's going to be a below the line. So it looks like to be some relief for like the teachers and other people out there that are in these positions and spend their own money that they are going to be able to benefit that regardless of whether they itemize or not.
Yes, I mean, there's been a $250 credit for that, an above the line deduction for years. Now this is going to be a expanded program for teachers because they're spending a lot of money out of pocket for supplies and stuff. So this would be a nice addition to their tax returns to be on the lookout for. And also too, on the charity side, I just wanted to take a step back. There is a new deduction for on the charity side. If you don't itemize your deductions, there's an extra deduction now that if you do the standard deduction, you will get a charitable deduction in addition to this, if you do the standard deduction.
Oh, great. I didn't catch that. That's great. That's good
Yeah,
to know about that.
yeah.
And I think as far as deductions, the last thing is that in the last act, the original Trump administration, they did away with this limitation on the amount of itemized deductions you could claim, right? They call it the P's limitation. Well,
Mhm.
that remains gone, but it seems that at certain income levels, they are going to be knocking down and reducing by about 2%, the really high income earners as to what they can itemize, they are going to be further limiting those itemized deductions.
Yes. Yep. It's if you're in the 37% bracket, you're really going to get 35%, benefit of your itemized deductions potentially, through that phase out rule in the one big beautiful bill.
Yeah, yeah. So let's move on to the businesses, right? I think something that applies a lot to me, clients I work with, clients you work with, is a qualified business income deduction, right? Section 199A that was out there. Lyle, that was the really, I think, one of the most meaningful parts of the new legislation, right? To create this additional deduction for small business owners. Whether it was stimulative or not, we don't know, right? I guess maybe we'll find out later. But it seems how I read that basically it just stays in line completely. Although I believe there may be they were talking about for the specified service trade or business, like people like you and us, lawyers, doctors, CPAs and the like, that there was a phase out, at a certain amount of income. But I believe there may be even at the highest level of incomes a little deduction, additional deduction there. What do you see in that, Brett? Without going too much, it seems like it stayed pretty much intact and didn't change much.
Exactly. The main difference will be, for businesses that aren't in that, doctor, lawyer, accountant, professional services type industry, it went from 20% to 23%, is the deduction. So we had a increased deduction for the 199A.
Yeah, yeah, really interesting. So moving on to the biggest topic, I think, from the that whole legislation was this concept of no tax on tips,
Yeah.
right? And it passed. I don't know how many of our people listening here that it'll apply to and the like, but what I find really interesting on it is that the tip, one of the requirements, I think it said, I don't know if we talked about this last time, but I saw it afterwards, is that the tip must be voluntary and it must
Mhm.
not be mandated. Right. So every time we go out, all these tips are included or whatever they might be, right? That's going to be real interesting to see how that plays out. That now in the passage of this, what are the restaurants going to do in including tip or these other charges they kind of put in there, right? That's really going to be a big thing. But other than that, I don't think it's a huge deal. This no tax on tip for most of our clients. I don't know what your thoughts on that.
Yeah, I mean, it's still subject to payroll taxes, Social Security, Medicare, state unemployment, federal unemployment. This will be a deduction that will be on federal income tax, and there'll probably be some new wrinkles, I imagine, as far as W-2 reporting, those tips. and how that impacts the personal income tax return. There'll probably be a new look of the 1040, the individual income tax return, to sort through all that. And yeah, I agree. I think, restaurants will, you know, look at some ways to, figure out how to account for tips going forward with this new rule.
Yeah, yeah. So that's really interesting. I saw there's now a deduction when you buy a car starting next year. You have to meet requirements. It's kind of seems to be replacing the EV credit that we had these last few years. It's that if you buy a car and you finance it, there's the interest on that car. This is not your business, personal, that you can deduct that
Yeah, ten
as
thousand
as as an
dollars.
interest expense.
Yeah, the car has to be made. Yeah, it's American. Yeah, it has to be made here in the U.S. There's some rules associated with that, but if those check the box, rules, up to 10,000 of the interest is deductible as an itemized deduction on your individual income tax return.
His item is very, very, very interesting there. Yeah. And so, one of the other big topics, it's always a very political topic out there, but it really did not, drive the conversation much this time at all. But whenever you get a new administration, a Republican administration, right, they want to eliminate or raise the exclusion for estate taxes, right?
Mhm.
That's common. People weren't talking about that much at this time, but they did raise it. So now that exemption is 15 million per person. So for a married couple, it's really at 30 million. And I'll tell you, as this gets higher and higher, while there is a lot of great wealth out there, it's just fewer and fewer people are falling into a category to where they are affected by the estate tax.
Yes, and if people were doing planning based on this, the 2017 Act expiring, definitely look now at revisiting those plans to, take into account these new, higher exemptions, gifting plans. If you have a closely held business with family members, looking into, structuring that to take advantage of these, higher limits now. So now that we have some clarity on what these, $15 million, 30 million for a married couple, lifetime exemption, estate exemptions, there could be some nice planning done.
Yeah, yeah, it's really interesting. And I think what was nice, well, we'll get to some of the, quicker wrapping up some of the items here. 529 plans that did pass that you can now use the funds within a 529 plan to pay for post-college like credentialing examinations, which I think is very valuable. That's very common. I see people end up with too much money in their 529 plan of their child. Maybe they can transfer it back to themselves, right? And use it for whatever that additional credential that they really wanted to get for themselves. And they've expanded a little bit about 529 plans and what you can use those expenses for. But those have really been the biggest areas, the biggest topics of the big beautiful bill out there, Brett, as we talked about. And I think from what was expected now. The big issue, right, is the addition to the deficit, right? So that's a little beyond our scope here. But talking about the effect of it, what came through, it's kind of like it's continuation of what happened before with some additional tweaks to it, but nothing like really earth-shaking in this bill that people need to really worry about, right? What's your thoughts?
Yeah, I agree. I think mainly an extension of the 2017, tax bill, but some good extensions, as far as taxes go. Yeah, the opportunity zones were expanded. So if you have capital gains from selling stocks on the market, or your company, you could look into opportunity zone funds. So that program was expanded, so you can defer gains, and there's some really good opportunities there. That could be a whole call just on opportunity zone funds
Hmm.
with the estate tax situation, those limits being raised. So there's some interesting, some of these new wrinkles and expansions are, um, will make it more helpful to plan, because these things are going into 2030. Some of these things expire. So,
Yeah.
bonus depreciation, if you're a business owner, you get 100% bonus depreciation. That went back up. So you could buy some, if you need equipment or trucks or any, heavy duty things, that'd be something to look into.
Yeah, excellent. The real quick on the opportunity zones, if someone's listening, they haven't seen it out there, or how I like to explain what that opportunity is if you have a sales transaction of whatever asset, a business, a real estate business, really big stock gains or whatever it might be, it's kind of it gives you an opportunity for like, hey, I didn't really plan. I kind of messed up. I didn't understand the implications of that. Is there anything that I can do now, right? That I've already triggered this gain? And those opportunity zones are really unique that, yeah, as long as you take those proceeds and with a period of time and put it in there, but there's going to be lockups and anything in there that the investment that it goes into, but they're interesting opportunities out there for someone that maybe is an alternative to deduct and reduce their taxes if they're not used to. So, Brett, listen, this has been awesome, buddy. I really thank you for your time. And we have this
You
one big,
too.
beautiful bill. I don't know that we'll have many other bills to talk about during this administration, but I think we got this one covered.
Yep, I think so too. Thank you very much for having me on.